Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Inflation is running rampant. In most major developed markets, inflation in consumer and producer prices is running at a multi-decade high. As central banks have adopted a tight monetary policy to counter this, investors are left to wonder if inflation can be tamed. Some market commentators have suggested that central banks raise rates quickly to slay the inflation dragon even at the cost of a deep recession. We beg to differ. We think that inflation can be tamed and a soft landing of the economy can be achieved, especially in the US. First, let's take a stock of the central bank actions so far this year. To start with, the three large central banks of the West, the US Federal Reserve, the European Central Bank, and the Bank of England in aggregate raised their policy rates so far this year by 6.25 percentage points. This is in addition to moving from quantitative easing to quantitative tightening of their unconventional monetary policies. Bank of Japan, however, going against the crowd, maintained its accommodative monetary policy. In the emerging market space too, central banks have been very quick in terms of responding to rising inflation. This year alone, emerging markets in the G20 group have in aggregate raised interest rates by 16.4 percentage points. This excludes, on the one hand, Argentina, which hiked its interest rates by a whopping 37 percentage points this year, and on the other hand, central banks in China, Russia, and Turkey, which have indeed cut their interest rates. Yet, at the global level, monetary policy is tightening at an unprecedented rate. For the context, for every one central bank around the world that is currently cutting interest rates, there are now 25 banks that are raising rates. Despite this record tightening in monetary policies, why has the inflation continued to remain elevated? There are many reasons, some that apply to any tightening cycle and some extremely specific to the present instance. In general, tighter interest rate policy works with a lag called response lag or impact lag. A combination of theory and practice points to a response lag of anywhere between 9 months up to 2 years. Worth noting that financial conditions as measured by credit spreads, equity prices, and the currencies have tightened already. In general, these financial conditions tighten before the actual impact of the tighter monetary policy shows up in the real economy. More specific to the current instance, various sectors are moving with varying degrees of progress towards achieving equilibrium following the pandemic-induced disruptions. Therefore, demand-supply dynamic has not reached the so-called steady state across all sectors of the economy. For instance, service sector is still recovering while the goods sector has started to normalize from a strong position. Supply disruptions add to further distortions. Furthermore, sensitivity of certain sectors to interest rates has changed over a period of time, making it difficult to estimate the response lag for those sectors. Now, if central banks are tightening aggressively and we know that the monetary policy operates with a significant lag, how does one know on what appropriate monetary policy rate is? Well, that's a $1 trillion question. As central bankers go on a tightening mode, they need to keep an eye on the evolution of the growth and inflation data to determine the appropriate interest rate level. Given the pace of policy tightening, it's easy for the central banks to miss out the obvious signal that they have done enough. This would account for a policy error. Now, looking at some of the more real-time indicators of financial conditions and looking at drivers of inflation including commodity prices, high-frequency house rents, consumer and business inflation expectations, etc., one should be able to sense a peak in inflation already. If anything, the months ahead are likely to experience strong disinflation. Against such a backdrop, the risk is that the monetary policy might start looking more restrictive than needed. This could also prompt market calls for deflationary outcomes, which are more painful than the inflationary outcomes for the economy. This is precisely why we argue that inflation should be tamed, not slayed. For financial markets, as we've been arguing, it is the market's assessment of the appropriateness in the monetary policy for the level of growth inflation mix that matters. This is in sharp contrast to the widespread belief that tighter monetary policy is bad for financial assets. A good example here is Brazil, where interest rates have risen from 2% to circa 14% over the past 2 years, yet financial markets there have held up well. Long story short, central banks are firmly in a tightening mode with an objective to bring inflation down. However, the clear risk here is that they go too far too fast and eventually commit a policy error. Until there is a confirmation that policy error can be avoided, financial markets are likely to remain volatile. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.